Thank you for joining us for today's webinar, Reducing Tax Risk for High-Growth Technology Companies. My name is Laurel Dobbin. I'll be your moderator today. Just wanted to go over a couple of housekeeping items before we get started with our presenters. First off, you can maximize or minimize the webinar pane during the presentation by using the red arrow buttons. During the webinar, we do encourage you to ask questions. In the webinar pane, you'll see the chat box that you can use to enter your questions. Just type your question in and click Submit. Our presenters will answer those questions as time allows during our Q&A session at the end of the presentation. To ensure good audio quality, please check your setting to ensure the appropriate audio option is selected. If you're using a telephone, please click on the Use Telephone Audio mode. Or if you're listening through your computer, then please click on the Use Mic and Speakers option. Also, please note as a participant, you'll receive a link to download the slide deck and recorded presentation within 72 hours of our presentation today. Now I'd like to present a quick overview of the California CE requirements for those of you who would like CE today. As a reminder, to qualify for California CE, you must use a personal computer, no PDAs, and log in with your own information and unique URL. Be logged into our online software for at least 50 consecutive minutes within the scheduled time frame of the webinar. You must actively respond to at least 75% of today's polling questions and complete the evaluation survey at the end of the webinar. And now I'd like to introduce our presenters. First off, we have Malcolm Ellerby, CPA and tax partner at Armanino. Malcolm has more than 25 years of experience in the multi-state sales use taxes, including 15 years with a Big Four firm here in the Silicon Valley. His primary focus is assisting software and other cloud service providers in evaluating multi-state sales tax application to their business models. Next up, we have Sanjay Agarwal. He's filling in for John Davies, who was originally scheduled to present today. Sanjay is an international tax senior manager for Armanino with more than 8 years of experience in tax accounting. In this role, he provides public and private companies in the Bay Area and Southern California with international tax consulting services. Sanjay earned a Master of Laws degree in taxation and a JD in business law. And finally, we have David Sordello. He's a CPA and partner in charge of corporate tax at Armanino. David has more than 20 years of public accounting experience, including 15 years at a Big Four firm where he served many of that firm's most prominent semiconductor, software, and internet company clients. He has experience assisting clients with accounting for income taxes, FAS 109, mergers and acquisitions, accounting periods and methods, R&D tax credits, tax audits, and state and local taxation. The learning objectives for today's webinar are as follows. We'll evaluate sales use tax exposure and resolution strategies as it applies to the taxation of technology companies. We'll describe ideal international structures to anticipate geographic expansion, and we'll review an effective tax provision process and structure. And with that, I'm going to hand it over to Malcolm to get started. Malcolm?
Thanks very much. Good morning. The focus this morning is on tax risk for high-growth technology companies. And as tax professionals, we're always focused on tax, but I think it's important to consider the life cycle of technology companies, and as these companies are early in their life cycle, they're establishing product and trying to gain scale and expand geographically. So compliance issues, whether they're internal controls or accounting related or tax related, and other infrastructure issues they're not as focused on. They're just trying to make the company viable and then scale. At a certain point in the company's life cycle, they do address some of the other issues as they mature, for instance, graduating from QuickBooks, for instance, to a more sophisticated ERP, accounting software system, and then internal controls issues, especially if they anticipate an S1 filing or an IPO, and then, of course, the tax issues, which is our focus this morning. Sales and use tax has really been a hot-button issue the last, say, 3-4 years with the emergence of the cloud-based services companies, including software companies that have migrated from on-premise software models to hosted models. And this morning we will go over evaluating the company's sales use tax exposure and how to resolve those exposures. And international issues are another hot button, and especially as companies expand. Some of the CFO roundtables that we host, international expansion is usually one of the topics, since it's so common for what I call inflection point technology companies that are, their revenues are doubling every year and they're north of, say, 20 or 30 million in revenue. They're expanding internationally. There are a lot of non-tax related issues to doing that, where to put people, how to structure things when hiring them, compensation-wise, and of course the international tax issues. And there are a lot of mistakes that you can make, and that you want to, surprises you want to avoid. So international at our roundtables, is including tax, is usually a hot button item. And then finally, we'll address the tax provision, tax accounting issues, which again, as compliance issues hit the radar of these inflection point companies and they realize, gosh, we need to get some structure around our internal controls. That includes obviously the tax provision and accounting for income taxes. And I've spoken, I know we have a very large turnout today compared to the norm, and I've spoken to several of you about simplifying your tax provision internal controls procedures. We've got some new tools to do that. This is the section where David's going to address that. So we have polling question number 1. I actually wanted to have some fantasy football starter sit questions on these, since this is really for the CPE, but they would not permit that. So let's go off to question number 1.
All right, thank you. Which statement describes your company's anticipated business path over the next 24 months? Please select one. A, IPO filing an S1. B, sale of the company. C, planning to acquire another company. D, none of the above. Or E, not sure. Looks like the votes are coming in. Give it a little bit more time, and then we'll shut down the polling in 5, 4, 3, 2, 1.
Okay, looks like 18% anticipate an IPO, or at least filing an S1. 10% say sale of the company. No acquisitions. 45% none of the above. 27% not sure. That's about what we would expect. So let's move on to sales tax surprises. Who cares? Well, if you're approaching an IPO or a sale of the company, at some point you will care, because someone on the board of the directors will come to the finance execs and say, I sit on the board of a couple other companies and think we might have an issue here. If you're a semiconductor company and everything you sell is for resale, maybe not so much. But if you are a software as a service or a cloud service provider, this has been a really big issue. As you approach an S1, or even if you're just growing and hitting your stride, as I discussed before, where you're rapid growth of revenue, you're doubling revenues, or significantly increasing your revenues each year, and you've hit that inflection point and you're 20, 30 million a year in revenue. It's just a matter of time before your financial statement auditors will come to you and say, by the way, doesn't look like you're filing or collecting sales tax anywhere. We need to talk about that, and they may encourage you to put some sort of accrual on the books. But the worst surprise that we see is when the company is the target of an acquisition and the suitor sends in their due diligence team, and invariably tax is a big part of that, and they discover that you have a $2 million potential exposure for prior periods on sales tax, and they want to escrow a big number or negotiate a purchase price reduction, and then the owners, especially if it's closely held of the company, aren't very happy. So then they're looking at the finance exec and saying, what's going on? How come why aren't we on top of this? So that's a big one. Other surprises that can happen, even with established companies, we've got a software company that evolved from on-premise downloaded software to hosted software. They didn't realize that was taxable in certain states. Again, public company, they thought they were on top of it. They're filing in 30 states, but they just had I think it was $1 million assessment in one of the states that fortunately we were able to whittle down a good bit. But, $1 million sales tax audits are not good surprises. So what I like to recommend, when I sit down with the CFO or a finance director to talk about sales tax surprises or exposure, I don't go in there saying, you guys need to make an accrual, you guys need to file in every state, you guys need to do this or that. My mission is to give management information to make decisions. And, we'll sit down and talk about their nexus. Do you have footsteps on the ground? Because usually if you're a software company, business to business, and you have large enterprise customers, big subscriptions, you've probably got people out in different states, regional sales teams. A lot of people think they only have nexus where they have an office or an employee, and that's not the case. If you're touching that state 3 or 4 or more times a year, footsteps on the ground, for instance, is what I like to call it, either with professional services people or with sales solicitation activities, you've probably got nexus. So we'll sit down and talk about that, and I'll get, say, 3 or 4 years worth of sales numbers and run that through a tax, interest, and penalty model, and then sit down with the CFO or the VP Finance and say, look, guys, here's what the exposure could be. A lot of your customers may have self-assessed tax, but at least that gives the finance exec ammunition to know, okay, I won't get blindsided. I can now decide what I'm going to do about it if I want to resolve this and start complying, or if nothing else, I am not going to get blindsided with a surprise.
Okay, we're going to go on to polling question number 2. How many states tax hosted software? A, 0, B, 17, C, 5, or D, 25? Again, remember, if you'd like CE credit, you need to respond to 75% of the polling questions. Votes are coming in. We'll go ahead and shut the polls in 3, 2, 1.
All right, 45% had the correct answer, B17. So that's a good segue into taxation of cloud services companies and hosted software. Actually, 17 is 17 states. District of Columbia also taxes it. One of those states is Michigan, and there have been a couple of big court cases in Michigan that have ruled. The Michigan Department of Taxation, their audit group has gone after it heavily, and they have lost with these 2 cases, but they're appealing both of them. So Michigan may indeed drop off of there. And it seems like every SaaS company I have has a lot of, especially the big B2B enterprise business models, have a lot of customers there. So the point is that it's evolving. It's much like downloaded software was 15 years ago, where you went from using CD-ROMs to downloads. Now it's cloud-based, and there are even other business models that are not just simply software. So the states can tax hosted software or cloud service, other cloud services, either as software or as data processing services, like Washington, D.C., Texas, and Ohio. There are gross receipt states that tax everything, like Hawaii and New Mexico. So it's kind of all over the board, and it's something that's evolving quickly as the states are a little bit behind. There's always a lag. behind technology and them catching up with technology. So it's really important to evaluate, and this is another thing that I'll do with the finance exec is please send me a copy of your MSA or statement of work or whatever the contractual embodiment of your service agreement is so that I can review it and understand the true object of the transaction. Is it really the constructive use of remote access software, or is the company using its software to provide a service to the customer? So that's a critical evaluation along with the nexus test. Those are the two evaluations that you need to conduct. So I guess at the end of the day, when I sit down and do this evaluation and sit down with the CFO, I'll usually email them the spreadsheet that does the calc with the tax, interest, and penalty, and that Excel spreadsheet in the lower right-hand corner, because they usually have nexus in most of the 17 states, and especially if their numbers are big and they are fast-growing and have a 4-year tail or 5-year tail behind them of prior period revenues, the number in the bottom right-hand corner of that spreadsheet frequently is quite a surprise for them. So then you sit down and say, look, this is not the end of the world. We can minimize this exposure. Your auditors probably aren't going to want you to accrue that full amount because you can probably haircut it because some of your customers have self-assessed, especially if you've got large enterprise customers. I have a feeling Coca-Cola and Procter & Gamble know which state's tax-hosted software and have already done so or been audited. So you can send out XYZs to your customers to kind of hopefully minimize the amount that the company actually owes. But it's important to remember, if you don't settle up with a state or start filing, there is no statute of limitations protection, especially if you have a longer tail. You've been around for a while, the state can come after you, especially if they audit one of your customers and see a $50,000 or $100,000 SaaS subscription. They'll probably set you up for an audit. So you can settle the prior period liabilities with the state by doing a voluntary disclosure. It'll limit the look-back period to 3-4 years generally. You can get a penalty waiver, which is anywhere from 10 to 25% of the tax. Texas gives you an interest waiver as well. And then if you all of a sudden find yourself, oh, we need to start collecting now in 10 states or 15 states, yes, that's an additional compliance cost. But again, it's kind of the price you pay for being successful, right? When you hit that certain point in your company life cycle, this is why you haven't done it before, but you kind of have to do it now. You can automate with tax collection software and filing software applications like Avalara and some of the others. And it's really not that bad once you clean up the past. So in summary, one of the CFOs that attended our roundtables, he said the company is very acquisitive. Every time we do an acquisition of one of these cloud companies, it costs us between $500,000 and $1.5 million to clean it up, and it takes a year or a year and a half to do so. So it seems like we're always in the process of doing voluntary disclosures and sales tax compliance. So there is a fix. You just have to do the evaluation and at least know what the number is and know which states to focus on. So that wraps up the sales tax portion, and let's move on to the international tax with Sanjay.
Thank you, Malcolm. So as high-tech companies expand, one of the main priorities is getting an international structure in place. And the reason why getting an international structure in place is so important is because of the ability to lower your effective tax rate on your foreign sales, because those sales are essentially made out of foreign entities as opposed to the U.S. And also, you're able to access customer bases outside the U.S., which is excellent in terms of increasing sales and revenue worldwide. A lot of countries nowadays are motivated to offer tax incentives to businesses. For example, in Singapore, you can get a 0% tax rate locked in for, let's say, 10 to 15 years with the option to renew if you have enough substance in that jurisdiction. Also Ireland, Netherlands, a lot of the European jurisdictions, as well as Hong Kong and also China are offering significant incentives for companies to move to their jurisdictions and set up their foreign principals there. There also is the ability to access human capital at a cheaper cost than the U.S., which is great for increasing earnings as well. Some of the risks for creating an offshore structure are the increased scrutiny of audits. We've seen ever since the economic downturn a focus by several foreign jurisdictions to target multinational corporations that are operating in their jurisdiction and really audit those companies on a hunt for dollars. The other risk is also the local tax and regulatory environment. Laws are constantly changing here in the U.S., and it's the same way in foreign jurisdictions as well, especially nowadays with the Organization for Economic Cooperation and Development coming out with the so-called BEPS regime, which is the base erosion through profit shifting regime. There's a constant focus on keeping an eye open on law changes, not just respect to international tax, but also local corporate tax and transfer pricing as well. So some of the benefits of having an offshore international IP structure are that your non-U.S. sales are not subject to current U.S. income tax. And what that means is really tax deferral. All of your foreign sales are essentially taxed currently in that respective foreign jurisdiction, but they're not subject to U.S. tax until those earnings are actually repatriated back to the U.S. Essentially, what you could do is if you're a U.S.-based corporation that's essentially California-based, you can lower your effective tax rate on your foreign sales from 40% to anywhere between 3 to 5%, let's say worst case 10%, by running your sales through a foreign jurisdiction. That reduction in your ETR leads to an increased earnings per share, which obviously puts a smile on everyone's face. Some of the considerations are that having an international offshore IP structure is not just a paper transaction. You actually have to have people overseas. You need to have fixed office space. You have to have legal entities in place. So it does require a change in operations, and that does lead to increased compliance because if you're a U.S.-based corporation, you're worried about filing your U.S. federal income tax return, your state tax returns, and maybe payroll tax returns, whatever it may be. But as you increase your operations to foreign jurisdictions, you have to deal with those local country compliance requirements as well. And then obviously the IRS scrutiny and challenge always comes into play when you're moving operations or you're moving intellectual property offshore because you're essentially eroding your U.S. tax base and moving profits that would otherwise be subject to tax in the U.S. to an offshore jurisdiction. And that's obviously gotten a lot of scrutiny in the past couple of months or so with the IRS targeting inversions, and they did take action towards that last week. So, I mean, that's something that definitely keep an eye on. So the benefits of having an international offshore IP structure are great, but there are definitely some strong considerations that need to be taken into account. Can we go ahead and switch to the next slide, please? Okay, so here we have a typical intellectual property structure. Here we have a U.S.-based corporation, and you can see from this graphic that all the U.S. sales are run out of the U.S. company. So the U.S. is selling products directly to U.S. customers in exchange for consideration, and those profits are generally taxed at 40% U.S. and state blended rate. This company has set up a IP holding company in the Cayman Islands, and the Cayman Islands entity has purchased the right to exploit the foreign intellectual property in exchange for royalty payments back to the U.S. So this is a taxable transaction. The good thing is that the consideration that the U.S. company receives can be offset with net operating losses to the extent that the company has net operating losses in the U.S. And the royalty payments that are paid from Cayman in exchange for the right to exploit the foreign intellectual property, that can be a lump sum payment. It can be a fixed rate royalty, which is a fixed amount for, let's say, 3 to 5 years, or it can be deferred payments, which would be a percentage of sales of the Cayman entity or percentage of foreign sales of any entities underneath the Cayman entity going forward. So you really have a lot of flexibility in determining how best to structure the IP migration transaction, but it is a taxable transaction in the U.S. And typically what we do is, for our clients, is we do a feasibility analysis where we would come in and we would value the IP. We would look at the different jurisdictions based on where the company has or is projecting to have fixed office space, employees, and really what works best for them. And for an international IP holding company location, and then also a actual sales location as well. And they may be the same or they may be different. Here, the intellectual property for international purposes is in the Cayman entity, but this entity has set up a subsidiary underneath, even though it's on top in the graphic, and that's in Ireland. And the reason for setting it up in Ireland is a lot of tech companies are currently based in Ireland. Ireland is getting a lot of scrutiny because of Apple and Microsoft. It is a tried and tested structure. It's something that could end in a few years, but it's definitely utilized by a lot of tech companies, especially here in Silicon Valley, to really lower the effective tax rate on foreign sales. Ireland has a 12.5% tax rate on foreign sales that are made out of the Irish entity. However, by having the Irish entity pay back a royalty to the Cayman company for the right to make, use, and sell in the international territories, we're essentially eroding our tax base in Ireland down to 3 to 5%. So you can see that this obviously has significant advantages. If those foreign sales were being run out of the U.S., the tax rate would be 40%, and we've narrowed it down to 3 to 5% here with this structure. The contract manufacturer for tech companies obviously would be a server. It could be a contract manufacturer, but in most scenarios it's a server. Ireland is essentially purchasing product from the contract manufacturer and selling directly to the non-U.S. customers. This structure is getting a lot of scrutiny. It was just reported this morning that the European Union is going after Apple and is targeting $4 billion in back taxes. So it is something that is getting a lot of scrutiny worldwide, but Ireland can easily be replaced by the Netherlands, Singapore, Hong Kong, Luxembourg, Switzerland. I mean, we've set up IP holding companies and foreign principals in various jurisdictions. And each country has their own regime, and again, you can get your effective tax rate anywhere from 3 to 6%. Next slide. So again, some of the key elements for tech companies are determining what the ideal operating structure is, and that is, where do you want to have your IP offshore? Where do you want to have your sales running out of? You do have the ability to also set up sub-principals underneath, let's say, the Irish entity on the previous slide to do business in more difficult jurisdictions such as China, India, Brazil, Argentina, and Russia, some of the hot jurisdictions right now where you may want to have a local entity in place just for IRS and local country tax authority purposes. Another consideration is VAT and withholding. Value-added tax is a huge consideration. We'll get to that on a later slide. Withholding taxes, again, we'll get to that on a later slide too, is a huge consideration when setting up foreign IP holding company structures, transfer pricing, and also entity choice. So creating an operating structure, again, some of the key elements are research and development and cost sharing. Something I didn't talk about on the previous slide, which is very important, is that when you're setting up a U.S. and then a foreign IP holding company structure, you want to make sure that you have a cost-sharing arrangement in place. And what that does is, and that's really blessed by the Internal Revenue Service, it's actually in the Internal Revenue Code and regulations, but it allows you to share in the costs of further developing U.S. and international IP between the U.S. holding company and the respective foreign IP holding company going forward. Another strong consideration is procurement. Where are you securing your foreign goods from? Are you using a contract manufacturer? Are you manufacturing the goods yourself? If you're using servers, where are your servers located? Are your servers creating a permanent establishment or a so-called taxable presence in that respective jurisdiction? sales solicitation and order acceptance. You want to make sure that if you have employees running on the ground in foreign jurisdictions and you don't have a legal entity there, that you're not creating a taxable presence through the activities of your sales employees. Order fulfillment and post-sale services are another consideration, and then obviously invoicing and collections. All right, and with that, we'll move on to our next polling question.
Okay, polling question number 3. Is your company considering an offshore IP structure? Yes, no, or not sure? Votes are coming in. We'll close the polls in 3, 2, 1.
Okay, interesting. So typically what we're hearing is that in Silicon Valley about 70% of the tech companies in this region have a international structure in place or are strongly considering having an international structure in place. So I think the numbers fall in line here. I would think that the no answers are, potentially startup companies that just aren't to the international phase yet, but would expect for that to come up in the next couple of years. And as I mentioned before, VAT and withholding taxes are a really strong consideration. I'm dealing with this now for a client where we're registering a U.S.-based company for VAT registrations in 20 to 25 different jurisdictions just within Europe. It's a strong consideration because VAT, if you have sales from the U.S. directly to customers in the European Union, for example, the VAT tax rate is anywhere from 14 to 23%. And if you have sales directly to consumers, the end users, that is your responsibility to collect the VAT from those customers and remit it to the respective VAT tax authorities in each EU jurisdiction where you have sales. The other one is withholding taxes. Withholding taxes are taxes imposed on related party and non-related party transactions, such as interest payments, royalty payments, service payments, basically any kind of payment that you could imagine between any two parties are potentially subject to withholding taxes. There is the ability to reduce the rate of withholding tax on those payments through tax treaties, and so that's definitely a strong consideration. It's part of our feasibility analysis that we do for clients thinking about expanding overseas. Okay, transfer pricing. So transfer pricing is something that is super important. In the last couple of weeks, it's gotten a lot more important because, as I mentioned earlier, the BEPS regime, which has been put out by the Organization for Economic Cooperation and Development, they're essentially an association of basically every country in the world. The only participants that are not attending those meetings are basically China and India. And they've essentially come up with a coherent plan to really have universal guidelines when it comes to transfer pricing regimes. And it's gotten a lot of scrutiny. It's very important that all intercompany transactions between related parties are properly documented and supported by economic analysis. And so transfer pricing is really looking at what is the compensation for related party transactions and how does that match up with what unrelated parties would pay for the same transaction. And tax authorities require worldwide that intercompany transactions comply with this so-called arm's length standard. The transfer pricing regulations in the U.S. and worldwide control nearly all intercompany transactions, and that includes the sale of goods, services, licensing, and even lending transactions, which is essentially the interest rate, the cost of money. Why should companies care about transfer pricing? Well, there's a need to justify intercompany prices to tax authorities. Tax authorities worldwide are going to look at intercompany transactions. They want to make sure that the profit allocation between entities in a worldwide structure is accurate, it's correct, and that profits are not being shifted to lower tax jurisdictions, and that each country is getting their chunk of the pie, essentially. And you want to make sure that you have proper economic analysis in place to support intercompany transactions and the pricing behind those transactions. Having proper documentation in place eliminates and mitigates transfer pricing penalties and interest if you're dealing with a transfer pricing issue on audit. IRS agents are required to request transfer pricing documentation. Most jurisdictions actually require that you file and attach your transfer pricing documentation for transactions with respect to that jurisdiction with your actual tax return on an annual basis. And transfer pricing is really critical to a successful offshore structure. As I mentioned earlier, moving your IP offshore has to be supported by a transfer pricing valuation, and having a valuation that's not accurate or having royalty payments that are not in line with the valuation of the IP can be disastrous in the future if it becomes an issue on audit. So what we recommend our clients to do when implementing a transfer pricing policy is to first identify all intercompany transactions, material and non-material, and then really have a transfer pricing practitioner put into account economic analysis of each intercompany transaction. And that's really called benchmarking. And what that means is that we do an economic analysis of what your company is doing in each respective jurisdiction and match that up with what similar companies are doing in that respective jurisdiction and what they're paying in that respective jurisdiction, and put together a transfer pricing report which can be updated on an annual basis or which can be updated, as transactions change easily, but really support the intercompany transaction. And it's clearly documented, by setting forth the guidelines, how the compensation was calculated, and what it was matched up against. The other essential part of having a transfer pricing policy in place is the intercompany agreement. The respective tax authorities are going to want to make sure that there is an agreement in place which documents the respective transaction, sets forth the consideration, and that the actual payments are being made, that there's actually invoicing in place, and that there's internal accounting policies in place to really support the documentation. As I said before, expanding overseas, whether it's setting up an IP holding company structure or whether it's setting up an offshore sales entity or having transfer pricing in place, cannot just be paper transactions. With the BEPS regime in place, everything is focused on substance, which means having people on the ground, having internal accounting in place, having invoicing in place, and really, making sure that everything is supported by documentation, people, and actually having legal entities, tax returns filed timely. It just, you can't have it be a paper transaction or so-called sham. And again, monitoring, updating is essential. The BEPS regime requires you to monitor and update your master files, your local country files, and your country-by-country files on an annual basis, and that's our recommendation to our clients as well, is to constantly monitor and update the transfer pricing files on an annual basis. Entity choice considerations. So during the duration of this presentation, I've really been focusing on offshore IP holding company structures and running your foreign sales through an entity, but it could be a lot simpler than that. If you're a startup company, you may just be looking at hiring a sales and marketing employee in, let's say, France or in England to really, help solicit sales and really market your U.S. company's product in that jurisdiction. So you start with evaluating whether it makes sense to have an independent contractor in place or whether it makes sense to hire an employee. Obviously, if you go the independent contractor route, you're more protected because you're dealing directly with an agency. But if you're going the employee route, you actually have to deal with payroll taxes. And payroll taxes, believe it or not, can be one of the most significant areas for audit and also for interest and penalties. The taxes are pretty severe if it comes out that employee taxes have not been significantly withheld or withheld properly in place. So if you're going to have more than a few employees in place, it may make sense to have a rep office. That actually requires a U.S. entity to register in a respective jurisdiction. It doesn't offer any formal protection like a branch or subsidiary does, but it gives you some type of legal presence in that jurisdiction by having a rep office, and offers more protection than just registering for payroll tax. The next step is to have a branch in place. A branch is good if you're going to have some sales in that jurisdiction. and you want to have more protection than just having employees on the ground or a rep office in place, you may be required to actually file tax returns in a jurisdiction, and it is more costly, but it does offer more protection. And then the most formal route is a subsidiary. Having a subsidiary in place offers the most protection out of all four alternatives, but it does have its annual costs, such as your annual audit costs, your annual tax return costs. There's a lot of filing costs associated with having a subsidiary, but that's really the best way to go if you are going to have sales and if you are going to have, let's say, anywhere from 5 to 10 employees in any respective foreign jurisdiction. Our strong recommendation is, if you are going to expand into a foreign jurisdiction, is that you definitely consult a tax advisor, because each jurisdiction is fact specific, and we work very closely with our affiliates in each respective foreign jurisdiction to really come up with the best game plan and really what's right for our clients on a case by case, jurisdiction by jurisdiction basis. With that, I'm going to turn it over to David, who's going to discuss the tax provision process.
Thanks, Sanjay. So, tax provisions. At the end of the day, you've done all of this planning. You've gotten you, Sanjay, and you've gotten your tax rate down to 1.5% or something like that, right, Sanjay? Now you're not dealing with the auditors, those evil auditors that come from the government agencies like the IRS and the Department of Revenue in each respective jurisdiction, but you're dealing with those other auditors that are actually your friends that you hire and pay to come in and issue your financial statements. And as part of that audit, one of the things that they definitely are going to want is to examine all of your tax exposures, make sure that you're calculating and booking your taxes correctly. And that's really what a tax provision is. And when you're, a tax provision is usually a fun process that happens at the very end of an audit in many situations, because you need to have entity by entity books in order to do it, and you need to basically have your financials done so that you can account for all the current deferred items related to the calculation of tax in each jurisdiction. So the considerations of doing a tax provision, and we'll dwell into this a little bit around what we're seeing and where we think tax provisions are headed. I've been doing provisions for most of my 25 years, which means that I essentially get audited by all kinds of people every day, so it's a fun life. But the things to think about are the systems and tools that we're utilizing to do the provision, the data needs, what kind of data do we need in terms of what the inputs are, and the supporting documentation to do that, and then things around uncertain tax provisions. Sanjay's 1.5% tax transactions probably going to need some sort of a reserve, because you're probably going to get scrutinized by the IRS, the local jurisdiction, and everybody else. So we need to analyze where do we stand on a more likely than not basis, and what should the actual accrual be over what we might be paying. And then finally, how do you take the books that you have, the trial balances and the financial statements, and actually produce a tax footnote that goes into your filing? The other thing you need to do is maintain tax attributes. In the tech area, some of the most common issues that you have are around net operating loss valuation. That means, can you use them? Are they limited? A lot of venture-backed companies have NOLs because they've been funded to develop technology and to build out their sales organizations, and so they have a lot of NOLs in their early years, and then hopefully they come out of that and start making money. Or maybe they do a transaction like Sanjay talked about and take their IP offshore and need to shelter that with NOLs. If there's a rule that basically says that if you've had a change in control, which is defined in only a way the IRS could define it based on value over a 3-year period with all kinds of different permutations. We do these studies for almost all of our clients almost annually or whenever there's a big event in order to determine what the limit might be, if there is a limit on the NOLs, so the client knows where they stand, as well as how we can document that in the provision process. The other one is an R&D credit, which is another valuable credit that the IRS has. It's actually out of the law currently, It expired at 12/31/13, but everybody's kind of just waiting for the IRS to do what they always do, or the Congress to do what they always do, which is retroactively apply it. It's also available in, and usually doesn't expire in states like California, Massachusetts, and Texas, and some other ones. And there's other attributes like foreign tax credits. Some of the things like Sanjay talked about with withholding tax might give you credits in the U.S. to offset your tax liability. So keeping track of those, understanding what limits may apply to them, documenting and supporting them. The IRS loves to come in and take away your R&D credits, and unless you have proper documentation, which doesn't just mean how you calculated it, but that the individuals doing the work actually were doing projects that qualify for R&D, is all very important. And both the real auditors and your friend auditors are going to want very high levels of documentation, or are going to want reserves against all these items. So depending on where a company is in its life cycle, it may outsource or insource a tax function. Outsource obviously means using a third-party provider like us. Insource means having your own tax department. Many of my clients actually have both, where we provide some level of a function and they do some of the work. And that's a choice that every company has to decide, is how best they can get their provision done, and use outside firms or internal resources to make sure that it's reviewed. There's also effective tax rate planning considerations, minimizing the rate, establishing structures like what Sanjay was talking about, as well as in a state and local environment. And there's other considerations like cash taxes. You know, many companies have pay no cash taxes, but they have tax rates because it's because of the accrual basis of accounting. And then the most important thing for most of my clients is we do a whole bunch of work to calculate the tax so that the external auditors can come in and review and sign off, and then we do a completely separate calculation on a pro forma basis, which they actually use for real reporting out in the marketplace. And so there's a lot of developments that have happened lately around pro forma and how you can do that calculation, that every company should consider, what's the best answer for them, both the short term and the long term.
Okay, and following up on that, we have our fourth polling question. The question is, how does your company handle tax provision? Do you outsource, in-house, use Excel, or use other provision software, or not sure? And you can select all that apply. Just a reminder, the PowerPoint and recording for this webinar will be sent to all participants within 72 hours. All right, looks like the votes are in. I'm closing the polls in 3, 2, 1.
So we got a few people that aren't sure how they do their tax provision, but other than that, the outsource seems to be, a very high percentage here, and we have a lot of people using Excel. So let's talk about Excel. I'm not going to deny it. Excel is my favorite tool. I play with it at night sometimes. But anyway, the Excel is a very powerful tool, and it creates a unique ability to link different workbooks, work papers together to do calculations. And it is the #1 tool that I believe is used worldwide to do tax provisions. The problems with Excel, which some of the challenges are listed here, is that it's such an open environment. There really are no rules. You can try to set up security protocols and double check things within different work papers and all those kinds of things, but it really is just an open environment, which makes it so powerful. The problem with that in an audit world is that you can have a lot of sheets with a lot of data on it, not even know certain data is within a sheet, or a sheet could be hidden, or a sheet could be old data, an old trial balance, or old information that's linked into a provision calculation. Something could not get linked properly. Many times when I do a provision, I'll get 5 versions of a trial balance, and every time I have to go back in and relink each book tax difference and each income to each jurisdiction, and so the process can get monotonous, and it can obviously lead to errors, which is probably why between RevRec and tax, those are the 2 most common significant deficiencies or material weakness areas out there. And when you think about it, you're dealing with a world of complex issues. You're dealing with multiple jurisdictions. You're dealing with multiple data sets. And so it's no wonder that tax has a lot of problems, and it's really just using Excel is really just a matter of, playing roulette and just waiting for your number to come up to probably get an issue with your auditors and then trying to talk your way out of it. So what are we seeing companies do? We're actually seeing companies move to try to move to a more automated process and move what we call beyond the spreadsheet. At Armanino, we've recently moved to a joint venture with a software provider where we are now trying to, for smaller companies, meld the benefits of having a tax ERP system, something that integrates the provision, tax return, and all the data sources in one platform, blend that with our provision expertise and working with our clients in both an in-source and outsource environment, and really come up with a more SOX-oriented provision process and try to make it much more efficient by eliminating all that linking I was talking about and relinking by using, today's tools and automation applications within the system. So that's what we are working on. I think it's just a matter of time before every company has to get to this, and it's something that I think all companies should be considering in the short and long run here. Some of the things that are really important in the provision process is to have people with significant provision expertise. The rules are, they're not necessarily always changing, but there always seems to be a flavor of the day from the auditors around what issues are new. And a lot of the areas are very complicated because they involve both, seemingly sometimes, ludicrous rules that apply from the accounting area to the same in the tax area. So you're kind of blending two different worlds together and trying to make sure that you're accounting for it properly using GAAP. So you need to have the right expertise either externally or internally or both. The next thing to consider is the technology that you're using, something that can automate a lot of the regular reoccurring transactions and repeating transactions. One of the things we're doing with our tool is to try to give a powerful tool without making somebody have to become an expert in the tool, as well as maintain it and get trained on it every year. So we're trying to basically take this in-house and just provide a powerful tool for our users with a tailored technology platform. Our system here also allows you to really do a lot of planning within it, like running what-if scenarios. What if we took our IP offshore? What if we had this royalty rate? What would our rate do? How would it change? And how would it impact our tax provision, both on a GAAP and a pro forma basis? So pretty powerful tools are out there. And then, just how do you get the data, all the different forms of data into the system? How do you set that up? How do you tailor it for each different company's situation? Those are all things that you have to do regardless of using Excel or some other system. And, again, moving to something that's more standard can really leverage doing this once and not having to do it over and over again and eliminate a lot of the problems that we have with Sarbanes-Oxley issues. So I'll let you guys read this at your leisure, just some of the benefits of a system like what we're trying to introduce into the marketplace today. But, to me, these solutions are really a no-brainer. I think there's huge efficiencies that can be gained both in the tax return and provision process, putting the two of them together, as well as just the whole SOX area and, converting a lot of the stuff that's done in the provision process in the preparation mode into spending more time in the review. The one other thing that I didn't mention is having a solution like this can change the way auditors actually audit you into more of a standard audit like they do in other areas of their audit, and take away from the going through every spreadsheet and tick and tying everything, which is where they spend most of their time reviewing a tax provision and where most of the issues actually come up.
Okay, we have one last polling question for everyone. What are common IPO surprises related to the tax provision? Sales tax liabilities, NOL evaluation or valuation 382, stock-based compensation accounting, or all of the above? Just a reminder, we might have time for a couple questions, so please do submit any questions in the question box. All right, closing the polls.
So
3, 2, 1.
I'm very happy to say that nobody picks sales tax liabilities because it goes back to Malcolm's who cares. We should care about sales tax, but they're not a tax provision issue because they're a FAS 5 issue and not below the line. So yes, the others are all relevant. Stock-based compensation accounting can be actually a very laborious task in a provision process, and we actually spend a lot of time with our clients doing that. So,
okay, thank you. So just to conclude the webinar today we've covered sales use tax exposure and resolution strategies, what to avoid and how to fix the problem, international expansion tax considerations, including location of servers, structure, VAT, and transfer pricing, and then tax provision considerations when preparing for the S1, maintaining tax attributes, and tax implications to be aware of when needed for an IPO. We do have time for probably one quick question. I'll read the question and then I'll throw it out to our presenters and figure out who wants to handle it. Sanjay, I think this one's directed at you.
Okay.
What is the difference between having a branch, a permanent establishment, and being a registered employer?
Yeah, that's a great question. So I'll take these in reverse order, actually. Being a registered employer in a jurisdiction means that you are registered to employ that jurisdiction's residents as employees of your company, and you are responsible for payroll taxes or any other type of withholding that is associated with employing those individuals. You're not a taxpayer in that jurisdiction, so there's no obligation to file any tax returns on the corporate side. You obviously have to file a payroll tax return, which may be on a quarterly or annual basis, but you're not an actual taxpayer in that jurisdiction. A permanent establishment is one that we deal with all the time. It's what I would call an unintended corporate tax presence in a respective jurisdiction. And that really means that through the activities of your employees or even your independent contractors or your office space, which could be Regis office space, for example, in a jurisdiction, you have created a taxable presence where the profits that are attributable to that presence that you have in that jurisdiction is subject to corporate income tax. It requires you to file a return in that jurisdiction. It's a nasty situation. It's something that you want to avoid. It's country by country specific. It's very fact specific, and you should definitely consult a tax advisor, like I said before, if you are potentially dealing with a PE risk in a jurisdiction. A branch is a intended taxable presence. So there you're basically conceding that you have a taxable presence in a jurisdiction. You're agreeing to file corporate income tax returns. You have some type of entity protection in that jurisdiction. So that is more formal. But when it comes down to it, the difference between branch and permanent establishment is a PE is unintended and a branch is intended. And with a branch, you can really dictate the results you want. With a PE, it could be nasty situation.
Right, and the only other difference between a branch and a company, which maybe is another part of that, is the branch is a look-through, pass-through entity in most situations, right, where the owner of that entity may also have to pick up the income or losses or get to pick up the income or losses of the branch. So it's kind of like having a partnership in the local jurisdiction as opposed to a corporation.
Right.
Great, thank you very much. Well, we've run out of time. If you submitted a question that wasn't answered, our presenters will follow up with you after the webinar. The presenters' contact information is on your screen now. Please feel free to reach out to them with additional questions. And as a reminder, you will receive the PowerPoint and recording of this webinar within 72 hours. I'd like to thank our presenters today for their time and their expertise, and thank you all for joining us.